Yo, what's good? Hope everyone's doing well. As always, we are now 2 full weeks into the new year. Hope everyone's started the year off well. Two full trading weeks. Back with video number 3. However, it's week 2, so I'm going to be going over just a couple of things today. First off is I want to explain a little bit on another confirmation that I use within my trading strategy. Last week we spoke about market structure, a real kind of simple breakdown on how the market moves and how the institutions move the market and how we would want to get in with the institutions to kind of, get on those bigger moves of the market. And yeah, this week I'm going to break down something else that I always 100% would look for, this certain move of the market before I kind of get in with any trade. And then yeah, going to use that and then going to give you a couple of examples really. So I took 5 trades this week, lost 3, won 2. 6% up, which is good. I think we did 4% last week, and then this week we've done 6. So my target is 5% a week. So we're kind of averaging on 5% a week, which is exactly what I want. So can't complain about that, to be honest. And then yeah, so it's all about that risk management, right? You're going to lose more than you win in terms of numbers of trades. But if you're only risking 1% or 0.5%, like I've been risking 0.5% just because it's the first 2 weeks of the year, don't want to get greedy and be silly about it. I want to get myself back in the rhythm. And the profits will just come. So it's just about being patient, not being a bell end and over leveraging and stuff like that, and just compounding that account. So I went over compound interest in the last video just to show you how powerful it is, where you can literally take like a £200-500 account and doing 5-10% a week, you could be turning over 6-7 figures in 5 years. Like, it's just mad, right? People want money quickly. They don't understand that the journey and like the rewards are there in the future. So anyways, enough of that. I'm going to get straight into it. So first I'm going to go over one of my confirmations, and then I'm going to give you a couple of examples on the actual trades that I took this week and the ones that we won. Right, so what I'm going to discuss with you guys briefly now is about liquidity and what liquidity is, because you're going to hear me mention this obviously in today's video, but also in future videos, because liquidity is basically a huge part of how smart money and institutional trading works. Liquidity is essentially money, right? And you might be thinking, what do you mean money? So money is essentially stop losses. So the market is always moving to grab liquidity, to grab money, right? If you're thinking the banks, institutions, hedge funds, these guys manipulate and move the market. All that they're doing is they're moving and seeking and obviously balancing the market, but also along the way they're taking people's money, right? The currency market is built for people to lose. It's not built for people to win. So a really simple example of this is, so if you remember back into last week's market structures, we have that consolidation phase, right, where we have equal highs, equal lows. Okay, what we have is equal high and we have an equal low. So either side of these support and resistances, we're going to have money, right? Liquidity. Because what's here? People's stop losses. There's going to be people here selling off here. What they're going to have? They're going to have a stop loss. They're going to have a stop loss above this high, and then they're going to be selling down here. You're going to have people buying here, selling here, right? So the bank knows this. They can see where people's stop losses are. And one thing that I always look for is, say for example, we have a area marked out on our chart up here that we're looking for price to come into before we get a move down. What normally happens, well, what always happens, and what we look to happen is that before this institutional candle, or where there's a point of interest, we're looking at, okay, what's the price doing? Does price stall and consolidate before it gets to that area? 9 times out of 10 it does. So what happens is it's enticing people in to buy, to sell. It's creating this liquidity. It's creating this money underneath this consolidation zone. And then what will happen is that price will blast through. It will take out all of these people's stop losses where they're looking to sell. And then what it will do is it will then hit our area of interest where we will be then looking to sell, based on obviously market structure and higher time frame analysis and all that kind of jazz. And then market will move down. So it's already seeked and destroyed this liquidity here, taken all these guys out. Then what's the retail person going to be doing? They're going to be thinking, fuck, okay, that didn't do what I wanted it to do. I'm going to then buy it back up when I'm then going to buy it back up when it comes down here, right? Oh, sorry. And then what they do normally is that, okay, so I've lost money here. I'm going to put twice as much here and over leverage because I need to make up for the money that I've lost. But then what happens is we seek this liquidity, we tap into our imbalance, our institutional candle, and then we go to the downside and we take out and we sweep out all of these lows as well. So this is what liquidity is. This is how it works. I know it's a real kind of brief explanation of it, but as I'm going to be mentioning it moving forward in my videos, it's really important you understand that liquidity is just money. Institutional banks, the market moves to seek liquidity, to seek money. What is money? Other people's stop losses. You have, and the most obvious one is equal highs and equal lows. You do also have this with trends as well. So if I just draw like a trend line, for example, you might have an upward trend. You might have price on one side coming up, down, like this, right? So we have, again, it works the same way. We have buyers here, we have sellers. You wouldn't have sellers. You'd have buyers here. Buy again when it comes and hits the trend. And then what tends to happen is, so we have liquidity here underneath this trend line. Then price comes back down, takes out trend liquidity. It then may come back up into our point of interest and then come back down into the way that we're anticipating the market to move. So just a bit of a shitty drawing, to be honest, but that's kind of, I'm just trying to explain, what is liquidity, what is money. Money is stop losses, and that's all you need to know really for now anyway. Obviously there is a little bit more to it, but this is the kind of liquidity 101 and how I understood liquidity, and how I'm going to show you now how I sort of incorporate this into my trading setups and how it just plays out pretty much 9 times out of 10. Right, so this is number 1 example out of 2 I'm going to show you. I'm not going to go into like all the details of why I took this trade, but I'm just going to explain the liquidity aspect of this and what I saw. So I always start off with high time frame analysis, which I might break down in a future video. But right here, what I noticed is I had an area of interest which was up in this wick of this candle up here. Okay, we're on the 4-hour time frame. I had an area of interest in this wick up here. What was in there for me was there was a 15-minute candle, 15-minute institutional candle, because it was a move up before this big move down, which basically started this big move to the downside here. So what I noticed is that price was creating these equal highs, right? We had one high here, bounced off of it here, bounced off of it here. So we had these equal highs here where I know that people are selling every time we hit this sort of support area here. So I know that eventually it's going to blast through, it's going to take people out, and then we're going to see that move to the downside, which is exactly what happened, right? So my area was marked up here. Maybe if I go to the 1 hour, we can kind of see we've got an equal high, price blast through, it taps into my area here, which I'd marked out. This green line was sort of my key area. It was a 15-minute candle, and it's also bang on a like 9200 level, I think it was as well. So yeah, a couple of confirmations in there for me, but for now we're bothered about liquidity. So yeah, equal highs, equal lows, right below an area of interest. This was my area of interest. It blasts through, taps in, and essentially comes down. I took profit from this one. I think it was at this equal low here. So yeah, I nicked about 4% from this one, I think 3-4%, because I only had half risk. But yeah, real simple explanation on how we come and we seek price, we take out the liquidity, and then we move to the downside. I'm not too confident on what this is going to do. It could potentially come and hit this daily candle here, this institutional candle. So this was a move down before a move up. Remember in the last video when I spoke about market structure, there's always a down move before an engulfing candle up, which essentially here, this has broke this structure here, broken this structure, And then, so we could be looking for a mitigation out here, but I'm out the trade. I was happy with the profits, and that was that. So that's CAD JPY. Another example that I have here is USD Sheffy. So again, real clean example. So I had two areas of interest here. I had one in this move up here. I think this was a daily candle. And then I had an interest here in this wick. So long wicks, wherever you see a long wick, is normally a good area for interest, because that means that there's a lot of money within these areas. There's been a price has pushed up and failed to stay up there, and it's pushed down, which tells me, I mean, which in most cases we have institutions in play. So here we had these equal highs. So there's liquidity here. See how I've marked out these equal highs. My area of interest was in this wick on a 15-minute. I think I had it. This is a 4-hour time frame. And then also another, sorry about that, another liquidity I had was this trend. So as price was making its way up to break this liquidity, there was a trend liquidity here as well. So I drew this out obviously in the before example, but if I just replay this back, as price was making its way up to my area of interest, which was up within this wick, we were coming to seek this liquidity, but then also building up people. So the people have got stop losses here, right? They're buying every time it hits this trend line. So as price moves, again, it doesn't break through. We have a big move up. We go and we're going to take out this liquidity now. That's taken. Now I'm being patient. I'm waiting for it to come into my area of interest. I'm looking on the smaller time frames as well. I've noticed that price is exhausting. I'm in the trade because I'm pretty sure I had a pending here because I was watching it. And then what happens is price comes down and blasts straight through this liquidity, takes all this out. And then again, we have equal lows. As well as we have equal highs, we have equal lows. I know that price needs to come and take all these guys out here as well. So there's going to be retailers in here waiting to buy price up. And what happens is it comes, wicks through, takes people out, and then just faffing about now, to be honest. But I got well out of that trade. So yeah, again, I secured a lot of partials, basically took a lot of my money out once it broke through and got to, I think, an area of structure here. So I was mostly out the trade here, and I'd hit my weekly target anyway. So yeah, that was that. Yeah, 2 good wins, 2 solid wins, exactly how price plays out, exactly what I've mentioned. And that's it. So yeah, I'm gonna wrap things up there. I think for next week, so as well as for anyone who follows me on Instagram, you'll see that I've recently started doing HFX trading as well, which is same, you're trading currency pairs, but you're trading it on the minute. So very different strategy. It's called high frequency. So it's normally I do 3-minute trades. But again, it's just another account that I'm compounding and I'm learning, and I've had, again, I think I did 10% last week on that account. So just trying to stay disciplined with it, because it's quite easy to just get carried away. But it's so fucking simple. You just got to be super disciplined. So I'm thinking for next week, I break down that as well. Maybe even do some live trades, because they are only 3-minute trades, just to show you how sort of easy it is. And if you are looking to get into trading, this is just an area where you can literally, sit there for half an hour and kind of, make a decent amount of money. So yeah, I just want to kind of share that with you guys. But yeah, I'll leave it there. Thank you so much for listening. And yeah, like and subscribe and all that stuff. But no, appreciate it. And yeah, catch you guys next week.